From the Volcker Alliance and the Penn Institute for Urban Research, this is Special Briefing. I'm Bill Glassgold at the Alliance, and I'm coming to you today from Rhode Island with my co-host back in Pennsylvania at Penn IUR, Susan Walker. Hello, Susan.
Hello, Bill. Hope it's
How are you
sunny
doing?
where you are. It's hot here, but beautiful day.
And lovely in Rhode Island, as always. In this episode of Special Briefing, we're focusing on one of the most pressing fiscal issues facing states today, tax expenditures. As revenue growth slows after the post-COVID boom and the cost of addressing climate-driven infrastructure needs expands, states need to take a much closer look at how they hand out as much as $1 trillion in personal and corporate credits, deductions, exclusions, exemptions, or any other tax benefits. And that's how California, the nation's biggest state, defines tax expenditures. And by the way, California provided more than $90 billion in such tax breaks in fiscal 22-23. To put that number into perspective, that $90 billion in reported revenue losses from tax expenditures way outdistances the $56 billion budget gap in the fiscal 2025 budget that Governor Newsom and legislatures just reached a deal to close. So to examine what this is all about, the Volcker Alliance has a brand new issue paper called Benefit or Burden, Evaluating $1 trillion in Tax Expenditures. The paper is authored by Matt Fabian and Lisa Washburn, our longtime public finance consultants at the Volcker Alliance, and they're at Municipal Market Analytics. And they look at how states often fail to adequately evaluate or sunset many tax expenditure deals. In the paper, we also look closely at 6 states, including some that have made notable improvements, and we provide a tally of tax expenditures by all 50 states and the District of Columbia. And you can download the paper on the Volcker Alliance website or watch social media for a link. On our panel today, Matt will be joined by 3 of the nation's top experts on tax expenditure policy: Utah's chief legislative analyst and my friend John Ball, Tim Bardick of the Upjohn Institute, and Arlene Martinez of Good Jobs First. We'll get underway in a moment, but first this word. We're coming to you live on the Volcker Alliance and Penn IUR websites, and also on the Special Briefing podcast. We've taken your questions in advance, and we'll ask them later in the program. And of course, this special briefing is made possible with the support of the Volcker Alliance, members of the Penn IUR Board of Advisors, and the Century Foundation. Thanks to you all. And now let's dig into tax policy. Matt, tell us about your paper's main takeaways and your and Lisa's major concerns.
Hey, Bill, thanks very much. So it is, this is not typically considered a the most interesting topic, right? It can be seen as a fairly dry area of a policy, and apologies to the experts on this call. But it is, but there's a time, right? There is a new urgency to consideration of tax expenditures. MMA, my company is a research group. We think that because of climate change and the costs related to climate change and the inherently inflationary aspect of climate change, that the amount of municipal bond issuance could as much as double or maybe more over the next 10 years. So that's an immense increase in the amount of infrastructure that needs to be financed. And that doesn't speak to, just regular deferred maintenance and infrastructure crisis and the effects of inflation on, regular state operating costs. So the issuance of debt is one thing. The paying debt service on all of that debt is another, right? And it suggests inherent budget challenges for the states ahead, right? Revenue shortfalls. And you can't just raise taxes to pay for it all because, that's inherently economically disruptive. And you can't just cut expenditures, but you have this area of state policy, tax expenditures, where we would argue that rather than calling it tax cuts or abbreviations or whatever you want to say, we would call it tax shifts, right? What tax expenditures do, whether it's for business or for other public policy reasons, is it shifts a tax burden from some parties onto other parties, right? It shifts the cost of governance for good reason, maybe, or maybe not. Maybe it works to, effectively customize a state's taxing regime, right? A state has many different parts, many different components of how it taxes its people, its stakeholders, its property owners, and similar. And the tax expenditures effectively customize that for the very specific nuances that each state wants. Well, it also, right, like Bill said, cuts about $1 trillion, and that's a very rough number made to point more out about like the overall magnitude of what we're talking about versus a specific number. That will inhibit, right? That makes it more difficult for the states to raise taxes in the future. So what do you do? We went into this project thinking that, we knew it was a survey and we were going to be looking at what is state by state policy choices around tax expenditures? How do they disclose it? How do they account for it? How do they oversee it? We expected a mess. It was much worse than that. It was the messiest situation, to the point where we're not even really advocating for true, actual public disclosure of the information. What we really want is for states themselves to get their arms around what it is they're doing, right? Think about this as a way that you, in the past, as a state, have customized your tax regime. And so, do all of your ideas work? Are they all still good ideas? You don't know that until you look, right? And so, part of it, part of our recommendation is, one, create some kind of disclosure. And disclosure means public, but it really means aimed at the legislators themselves, just so that people know what's happening. With their system of tax expenditures, create as a set of performance indicators, whatever you think is important for your state. And we're only looking at really major ones, right? There are hundreds in many states. So look at the major ones, create performance indicators that you can track. Are they fulfilling the initial policy purpose and the initial political purpose for which they were created? Those are different. We advocate for sunsetting, right? So that, which doesn't mean that they're necessarily bad. It just means it refreshes legislative consent that this is a good idea, that we want to keep doing it, because really, what does it matter? Like, we're not necessarily judgy about this versus that. It's the legislature's choice to do what they will, but make sure that they still want to do it, right? And then also, to the extent you can find out that this shifting of taxes is creating a burden on the parties to whom the taxes have been shifted, or the ones where the cost has been shifted away, maybe don't need that benefit anymore. So that's ultimately the point, right? This is a way for states to set up their tax regimes for the future, which is likely to be more difficult, right? Is going to be more costly, and will strain every state's ability to tax their economy. And so, to minimize the economic disruption of any tax hikes, just look at those expenditures and get your situation in order so that you're better prepared. And then let me just say one more thing. For how people like myself, right, people in the municipal bond market or other outside observers can be a part of this, it's really evaluating, are the states doing this? It's a management consideration. It's a governance issue. Are states doing the work? As this is one part of the puzzle of, are these entities still as creditworthy as we thought? One way that they can prove that is to show that they're doing the work and making sure that they're not taxing haphazardly for the future. So, Bill, back to you.
Well, Matt, let me just ask you one
Sure.
quick follow-up question before we turn to John Ball. You and Lisa went dug closely into a bunch of states that have made improvements. Some of them are in the report cards, in the report. Some of them are in the report text.
Yeah.
Just mention a couple of those, like Washington, Utah, I recall, where they actually have a more durable evaluation system.
Oh yeah, no, let's take Washington. Washington is great. And I hesitate to talk about Utah because John's on the call and he'll talk plenty about Utah, let's hope. But the Washington does a great job. One of the better states, I'd say, as far as overall oversight. They have a system of independent evaluation of all of their expenditures. They have a schedule by which all expenditures need to be reviewed. They use full-time professionals, not just stealing time from various desks in the state capitol, to be doing this, including outside oversight. And that's about, and there's reporting related to all that. So that's about as good as it gets, right? In the as far as the U.S. Maybe they do better outside of the U.S. I don't know, but inside, but what they don't do, right? They don't have a systematic process for evaluating every tax expenditure in a similar way, right? Everything is still, dependent on the creation of the product or the area. And they don't have a sunsetting provision. Sunsetting is so critical, right? Because Bill, you've talked about this. I always think it's a great point when you talk about the comparison to debt or some other, long-term obligation on the part of the state. They could create a policy now that costs, whatever, millions of dollars a year forever without oversight, right? And so adding a hypothetical endpoint to that, saying this has to sunset every 10 years, and the legislature, all they need to do is just to vote it through again. And then we know that it's still, in their view, a good idea, and that should be good enough for us.
Well, fair enough. And as you said, we're saving Utah for John Ball. John's the chief legislative analyst for the Utah legislature, and Utah, along with budget stress testing and long-term budgeting, has made some steps also in evaluating tax expenditures. I know you don't have a pro football team yet. You may have to look at some kind of tax subsidy for that down the road. But tell us, John, about what Utah has accomplished.
Yeah, thanks, thanks, Bill and Susan. Thank you very much, and thanks also for the shout out in the report. I know we didn't score very well overall, but at least we had a little positive mention in the report for Utah. So thanks for that. It's kind of like being the tallest building in Salt Lake City, though. We're going to strive to do better than that going forward. We really have 4 tools for evaluating tax incentives in Utah, and they're sort of go in order of decision making, as you would expect. The first one is our fiscal notes. So on every piece of legislation, we do a cost estimate, and those cost estimates include foregone revenue. So if we get an incentive, even if it doesn't hit the tax stream immediately, we explain, hey, you guys, here's your opportunity cost for doing this. You're actually going to forego this revenue growth in the future. We don't budget to that. That's maybe a shortcoming. You don't have to deduct that from revenue in a given budget cycle because it's speculative prospective revenue in most cases. But at least we do try to recognize it up front. The second thing we do in Utah that is maybe goes a little bit to what Matt was talking about is we do something called dynamic fiscal notes. So these dynamic fiscal notes are not they're not budgeting tools. So that first fiscal note I mentioned, that's a budgeting tool to help us balance the budget. This other one is more like a policy debate tool. And in this tool, we present sort of 4 economic scenarios for a given policy choice, and those scenarios use different assumptions on dynamism. So things like backward linkages and multiplier effects, and we don't tell the bosses which one of these 4 is the right or is will be the outcome, but we at least say to them, hey, here's what would happen if you had 100% participation in this incentive, or if a producer took all of their savings and put it back into jobs, what would happen to wages, what would happen to revenue, what would happen to economic activity. So that's another tool, sort of prospective tool in making these policy choices. The third thing we do, you guys mentioned a bit earlier, is we have this regular scheduled set of reviews for tax incentives. So we do these, and I think we actually started doing this recently because organizations like yours were suggesting it, and it's a really good idea. So we do 2 a year. I have a staff of 5 economists led by our chief economist, Andrea Wilco. Those folks look at 2 of our tax incentives every year retrospectively, and they think about, is this working? Is it accomplishing what we thought it would accomplish? How much does it cost? This year, we're doing high cost infrastructure tax incentives. So this is like refineries. And we're also doing enterprise zones this year. And we'll present that to the Revenue and Tax Interim Committee, and they can make choices to change these incentives. And I know the first question I'm going to get after this is, well, do they ever change anything? And the answer is they do, but I don't think it does what we think it was going to do. Like they'll make little marginal changes, but it's not like wholesale we're throwing out this incentive. Maybe they target it, or in some cases they even broaden it to say, we're not actually getting uptake on some of these incentives. And then the final thing we do, you mentioned a bit, Bill, is we do risk mitigation through budget stress testing. So assume all of these things happen, the incentives go in place, then what? And we do this through a 3-year cycle. The first year is revenue volatility. The second year is long-term budgeting. And then the third year, we take those two pieces, those two long-term outlooks, and we mash them up, and we assign to them different economic scenarios. So we might do a 2001 type recession. What would happen in the future if we had a 2001 type recession? What would happen in the future if we had a 2008 type recession? What would happen if we did stagflation like 3 or 4 years ago and everybody thought we were crazy? So we try to then measure our value at risk and say, do we have plans in place to, if we were to have our worst day, would we be able to address our worst day? And if we don't, we make recommendations on how to increase those buffers. So those are the 4 tools. I mean, there are things we don't do well. We can maybe go into those later, but I mentioned some of them. I just wanted, before when I wrap up, I want to talk about, even with all of this work, it's sometimes these decisions are not about economic activity and jobs and return on investment. I joke that we don't have to do we don't have to do any kind of incentive in Utah. All we got to do is go put a sign on I-80 in Berkeley that says Utah this way, and people come here, jobs come here, corporations come here, but we still do them. We do, for instance, we pay $12 million a year for rural tax incentives. Rural film tax incentives, film production incentives, and jokingly, that's so Kevin Costner will make more Westerns. But it's actually a shift from all of Utah to rural Utah, because it's very important to these rural communities that they're getting this investment. These are very small towns in the middle of deserts, literally. And this is really, one of their lifeblood, sources of lifeblood. So that's an intangible reason, or maybe a tangible reason, to do an incentive, even though it might not make money. I had one of my former bosses. I was once trying to explain to him how film tax incentives don't even break even, and he said to me, "Well, Jonathan, I'm not doing it to break even. I'm doing it because I like films." And I want films to be made in Utah. And so sometimes it's not about the economic return. Sometimes it's about some other public good, is my point. And I think we need to recognize that.
Well, thank you very much, Jonathan. That's great. We really enjoy your perspective from Utah, John. We will come back with more specific questions. For example, tax breaks that involve not just rural area, but Salt Lake City. But that perspective, which goes beyond economics, is of course really interesting. But now let's turn to a renowned economist, Tim Bartik, who is the senior economist at Upjohn Institute. For how do you, Tim, view these tax breaks, tax incentives? How do you view them?
Well, I agree with what's been said so far. I mean, I'm going to focus my remarks on business tax incentives for economic development, because that's what I do research on. And so I want to first point out that I'm focusing in on just part of the picture. This report said there's $1 trillion in state tax expenditures, or there might be. Business tax incentives for economic development at the state and local level might be $80 billion a year. It depends how you define them, but maybe 8% of this, but they're among the most controversial, because a lot of them are very big awards of specific companies and very special tax treatment. And I guess what I would say is, what I would be calling for in this area is first of all, having a budget for these things rather than having it unlimited, so that states should say, here's how much we're going to devote to economic development tax incentives per year. And then they should be reviewed. And in reviewing them, we need to avoid the problem that frequently people exaggerate either the jobs impact or the economic impact of those jobs. And we need to get force people to realize that some of these things are exaggerated. Let's have more realistic estimates based on the research. And I think that will lead then to some cutbacks and some more targeting of these things. So what do I mean by exaggerated jobs impact? One thing you frequently see when state economic development agencies are trying to market their programs to the public and to the legislators is they claim that every firm they touch would not have located in their state but for the incentive, that all those jobs would not have existed. And the reality is that's not true. I mean, if you're offering, a modest incentive of $10,000 per job, which would be modest, or $20,000 per job, that's not going to tip 100% of the firms given that. I mean, in many cases, that industrial site, even if that firm wouldn't have come, some other firm would have occupied that site. So we need to have more realistic numbers. In some of my work, I've said it kind of depends on the size of the incentive. I have some ground rules there. For average incentives, maybe 10%, 20% are actually induced by the incentive. For very large incentives, it can be like 70%, but it's not 100%. Second thing is multipliers. You see huge multipliers claimed. I would take whatever multiplier someone is currently claiming and cut it by a third and see if it still makes sense. The project still makes sense. And the reason you want to cut it by a third is that when a lot of these multipliers don't take account of the feedback effects, that when a company is located in an area, yes, there are some multiplier effects, but wages and land prices go up, and that has some effects of retarding economic activity. And another thing, people claim all kinds of agglomeration economy effects, like that every incentive is going to create a new Silicon Valley. Well, okay. Maybe it will. In many cases, it won't. So I would cut back the multipliers by at least a third. The other thing I would do is reckon with that not every job and the payroll you bring is not all actually raising per capita earnings of people in the state. The research shows that on average, when you bring in new jobs, only 20% of those new jobs raise the employment to population ratio. The other 80% raise the population. And when an area is already booming, actually, in many cases, 95 or 100% of the jobs actually boost the population. In a more distressed area where there are a lot of non-employed people, it might be 40 or 50% raise employment to population ratios. So we need to take account of the fact that a lot of the earnings really are not increasing the standard of living of state residents. They're boosting the population, but that has both pros and cons. And in particular, on fiscal effects, you will see all kinds of analyses that just look at the tax revenue effects of additional economic activity, but totally ignore the public service demand effects. And that's really problematic. I mean, it sounds like Utah is different from this, but I've seen any number of analyses by state economic development agencies that completely ignore public service impacts of these projects. When you bring in jobs, it will bring in some people. And that is the students are going to need additional teachers, going to need additional police, additional fire, additional infrastructure, going on and on. Usually take whatever tax revenue effects, and the true fiscal benefits are probably 10 to 20% of that at most. So what should happen? In my view, if we have more realistic evaluations, people will decide some of these incentives don't make sense. They'll also decide to target them to some extent. They'll target them at higher multiplier projects once they cut back the multipliers, but I still think it makes sense to target higher multiplier projects. And they will also target more distressed areas because, frankly, if an area is already booming, why you want to provide additional incentives is beyond me. It simply doesn't make that much sense. You're simply giving away tax revenue. And that has some negative effects in terms of undermining the long-term ability of the state to compete. And by the way, I do think this kind of evaluation can make a difference. So the state of Washington was mentioned, and I agree they have a very excellent evaluation system. At one point, I and one of my colleagues at the Upton Institute, Kevin Hollenbeck, did an evaluation for the state of Washington for the legislative committee that does these evaluations of an R&D tax credit in the state of Washington. And we concluded that it did not have very significant effects, that it was not really significantly increasing economic activity in the state of Washington. It was mostly subsidizing R&D that would already have occurred in the state and not really boosting the economy. After that review, as part of the review, they got rid of that tax credit. So I, in fact, think that evaluation that takes a more reasoned view that these things can have benefits, but they also have cost, can make a major difference to what states do in the future. And that's what I think states are starting to do. I agree that they're going to be forced to do it with a more austere fiscal environment. And I think if we target these incentives much better, the benefit cost ratio of them will be much better than it is currently.
Thank you so much, Tim, for that great overview and lots of interesting points that will promote some discussion. We'll come back to them. But now let's turn to Arlene Martinez, who is the Deputy Economist of Good Jobs First. And Good Jobs First make sure that tax breaks produce what is promised. Tell us about your work, Arlene.
Well, Susan, actually, let me just interrupt for a second because it's about almost at the midway point, and I need to remind you all that you're tuned into Special Briefing from the Volcker Alliance and Penn IUR. The archived editions of all of our special briefings are on our websites and the Special Briefing podcast. And now, Susan and Arlene, the mic is yours again.
The mic is yours, Arlene.
Thanks. By the way, I'm the Deputy Executive Director. I'm not an economist before I got here.
Well, good, Arlene. We
want to clarify that.
You. Yes, thank you.
Yeah, Arlene, like me, comes from the world of journalism, and we're both lay observers.
Right. So I was a journalist for many years before I got here, reporting a lot on local spending and budgets, so I could see what would happen when communities were strapped for cash and what the programs that often got cut, which were often programs that targeted low-income folks or vulnerable people, because they tend to have less of a voice in the process. So just like Tim, I'll also be talking about the economic development incentives portion of this tax expenditures report, which, as you noted, covers many, many different types of tax expenditures. So companies are like families. They pay income, consumption, and property taxes, and they get tax breaks on all of those things that the rest of us pay. And I like how the paper framed the shifting, because it is a shifting of money. If someone's not paying, someone else is, or services are getting cut. Those are the choices that happen when a community is strapped. So every state publishes a tax expenditure budget, but like the Volcker Alliance makes pretty clear, they're really uneven the way they're done. They're irregular. They can even change in format from one administration to the next, we've seen. In about a half a dozen states, nonprofit watchdog groups have published what we call unified economic development budgets. That takes into account all kinds of spending for economic development, tax breaks, grants, loans, technical assistance. And those consistently find that expenditures dwarf appropriations, in some cases 6-to-1. So in our 26 years of Good Jobs First, one of the biggest the increases in state spending that we see are in corporate income tax credits. Those are activities you get for R&D, capital investment, and hiring. And these have soared because technology and manufacturing projects are increasingly capital intensive. When you think about your battery factories, electric vehicle plants, semiconductors, oil refineries, chemical plants, all are extremely capital intensive. A problem with these corporate income tax breaks are how secretive they are. In a lot of states, they're not revealed at all because they're on a income tax return. So they're covered under these secrecy laws. Now, that's not the case in all the states. And I think there's a case to be made that those should be reported in every state. Another big thing that we've seen are sales tax exemptions. That's been a real trend for the construction of new facilities. So they don't have to companies don't have to pay sales taxes on building materials, machinery, equipment. So all that rewards capital intensity. We're seeing this quite a bit with data centers. There's been a real growth of data centers because of AI and crypto, which is really putting a big strain on the energy grid. And there's a question to be asked about whether companies like Amazon, Microsoft, Google, a lot of the big companies that are getting their tax breaks should be given the public's money to do what they have to do anyway, because this is the future. This is where everyone has to be. They've got to be building these data server farms. And just in one example, Virginia lost 135 million to sales tax exemptions in 2022. It's 135 million. And then by fiscal year 23, it was losing 750 million. So that's a giant increase from year to year that Virginia residents are going to have to make up in some way or another. Data centers also get utility tax breaks. That's a different matter altogether. And those are really secretive too, and really adds on to the cost of the tax breaks that are enjoyed really by typically some of the biggest companies. But the biggest tax that companies often pay is the local property taxes, and those have often been the most opaque. But that changed recently as the report goes into the Governmental Accounting Standards Board's statement number 77 on tax abatement disclosures. That was the first time that GASB mandated that tax expenditures be reported anywhere on one of these end-of-year spending documents. So since 2017, that's been a requirement. They have to put a note on their report that says this is what they lost in the previous years. And this was important because even governments that lose revenue passively are covered under this. So school districts, which often have no say in whether their money is given away through these incentives, have to report the revenue they're foregoing. And it's the only, as I mentioned before, the only time that GASB's codified any form of tax expenditure. We run something called Tax Break Tracker, where we try to track the revenue losses in the biggest communities in every state. But one thing is that transparency doesn't equal accountability, and it doesn't ensure that a program is justified or effective. So the report really goes into that quite a bit about it notes how rarely some of these places evaluate the effectiveness of their programs. And this is especially true when something's as of right. So they're not subject to any annual appropriations debates. And when you think about when budgets get tight, the things that get cut, as I mentioned when I opened, that appropriations often get cut. So worker retraining programs or universal pre-K, things that we think do work for creating healthier futures for people. But tax breaks are often untouched. And then when budgets are doing really well, we often see these subsidy packages boom. So when states were really flush with this CARES and Rescue Plan Act, we saw really large packages. In 2022, we documented 8 individual factories that had received more than $2 billion each, just from state and local governments. We call those mega deals. We also saw a pretty big growth in film subsidies. A lot of states had gotten rid of film subsidies because they're so ineffective when it comes to economic benefits. But we saw even those same states whose own auditors had shown how ineffective they were bringing them back. We also are seeing a big flush of stadium deals too, which are also ineffective drivers. And then another issue that I just want to flag is who wins in some of these things. One of the things that GASB 77, the Statement on Tax Abatements, let us see was at a local level, who are the winners and losers? And what we saw with a lot of our studies that we've done using those ACFRs are in communities like St. Louis, Kansas City, and Philadelphia, which have large Black and brown populations, losing a lot more per student than neighboring majority white suburban school districts. So we see the poor are paying more for these things. And you can talk about team spirit and the rah, rah, rah feeling of having a sports team in your community. But when you're a working family, ask them if they would like to pay for a stadium that they'll probably never be able to afford to go to because the ticket prices have gotten so high. Went to a lot of sports games when I was younger with my dad, and he was a public school teacher, and he could regularly take us to games, which just wouldn't be the case now. The last thing I just want to talk about, which your report goes into, is the issue of the tax code modernization. As the report notes, that these things are not evaluated very often, and some of these have been on the books for decades. Just one I want to flag is something called the vendor discount, which was adopted during the Depression when you used to have a cash register and you had to manually figure out how much you owed in sales taxes. Now a lot of that's automated. And again, that's been since the Depression, and that's $1 billion per year we documented across the country. Not a lot, but $1 billion here, $1 billion there, $1 billion there, it all adds up. And Illinois, just this month actually, finally redid its vendor discount that had been in place since the Depression, where there's still a tax break. So small businesses that rely on that a little bit more still get to take advantage of that. But the big companies like Amazon and Walmart that were really getting millions of dollars in benefits now also will just get a very small portion. So now, and I will end on that.
Well, thank you so much, Arlene. And now we will turn to our questions. Bill, you have some from that have been asked earlier.
We certainly do, Susan, and thank you, Arlene. I just wanted to follow up with a point that Arlene and Tim both made about the cost of tax incentives. A bunch of states are providing incentives for semiconductor plants on top of federal tax incentives under the Science and Chips Act. But some of these incentives are going to states with that are very dry. Arizona is really positioned itself to be a chip making center, but your average chip factory, I've been told, uses about as much water as a community of 300,000 residents. So we have to think about the extra strain on the water system. We just did a special briefing recently on how San Antonio has a 40-year plan to source water 130 miles away. This will be paid for by taxpayers, by ratepayers over time. But it speaks to the cost of bringing in new industry and bringing in new residents. And I think it's a very important point. We have a question from Alexander Marion, the city auditor in Syracuse, New York. This is a guy who's on the front line, who's got to say whether the annual comprehensive financial report is kosher or not. And he wants to know, can you share some of the best practices for publicly reporting data and increasing transparency for these agreements? Many of which happen, as Arlene mentioned, with non-disclosure agreements. It's a jump ball. Maybe John wants to talk about how you're doing it, and Tim and Arlene. And Matt, of course, who studied this.
Yeah, I can just reiterate some of the. So we recently had 2 stadium deals. People mentioned stadium deals, so we had 2 at the same time. We had one for the Utah Hockey Club, so thank you, Arizona. We now have a National Hockey League team in Salt Lake City for the first time ever. And at the same time, we had one for a prospective Major League Baseball team. And it was really the public policy dialogue that was our main source of disclosure. And of course, we did really in-depth fiscal notes on both of those beforehand. Literally the first time we ever broke our fiscal note system because we had too much data in it. So that was our first foray into it. But that's before, this has just happened, so we don't have reporting after the fact on this yet. But then I love what Tim said about this concept of testing your assumptions and not just saying, here's what we think is going to happen on a fiscal note, but saying, hey, what if we're wrong? What are the other things that could happen? What if the multiplier is 1.3 instead of 3? Or what if there are no backward linkages and nobody comes here? What happens in those cases, and getting those out in the policy debate beforehand, I think is super important.
I guess what I would
Go
add is
ahead,
that
please. I'm sorry.
transparency is great. And I think certainly I'm all in favor of disclosing all elements of individual deals, as well as states post having dashboards where they post program data, which some states do. But I really think the key is the in-depth evaluation. I mean, if you just post stuff on a website and okay, so maybe there's going to be an article in whatever local newspapers still remain. But you need to have some kind of legislative audit bureau or some kind of government audit bureau or evaluation group that can really get access to all the data, that has sufficient expertise, where they have economic impact models, fiscal impact models, so that they can actually crunch some numbers on some of these things. Because all you do is post it and it's never evaluated. I'm not sure how far that takes you, other than a few newspaper articles, which these days, how many reporters are left to do the articles?
I think go ahead. Just to tell you that's an excellent point. It's how do you spark the debate? Arlene, please.
Just a quick note, we like to see broken out by type of subsidy program. So even if you provide the aggregate, and some places don't want to give the company names, but even if you can break it down by program type in your ACFR that you're producing, tax increment financing, we'd like to see those which are some of the more costlier programs disclosed in there. Gross versus net is something that we deal with all the time when we're trying to make sense of this. So make that clear. Those are just small things that we'd like to see.
And then if I could just add, and this is less of a best practice that I've seen and more of one that I would like to see. And just so you know, the report itself outlines a number of transparency innovations that we think are good ideas, taking from examples that we've seen and sort of, putting that all together. But, one thing that we have, and I don't know, maybe Tim, maybe you have seen this, but we didn't see in any of the situations that, or the reports that we reviewed, a clear explanation of the policy and political reasons behind each tax expenditure. And this is, I think it's less important for the business incentives, because those are pretty obvious. You want to have jobs and things like that. But for other, other tax incentives, like around sales tax exclusions or this and that, like why exactly this is happening and what are the politics behind it, so that that's something to be tested, right? That points the reader toward a system of evaluation. If you know why something has been created, then you can test, is that thing happening? It makes it a lot easier from that perspective. So
I think at least some states do that, because I mean, I know I participated for the last 7 or 8 years. Pew Charitable Trust and National Conference of State Legislatures, NCSL, have sponsored conferences where they bring together people from state legislative audit bureaus. And the NCSL actually has a database of evaluation reports. And I know a lot of the legislative auditors are quite serious about, they get very uncomfortable if they can't identify a purpose of the program they're evaluating. They really try to look at the legislative language to see if it states a purpose. And then they try to do an evaluation of whether it's meeting that purpose. And they really take that quite seriously. Does the bill that authorized this tax break state a purpose? Is it job creation, or is it something else?
So let me follow up on that with you, Tim, actually, and then generalize a question a bit more. And that is there clarity about what a tax expenditure is, or does it depend on kind of the neutral starting point of what the tax is? How do you think about that?
Well, I think it does depend. I mean, for example, in discussing economic development tax breaks, we've kind of referred to this already. I mean, the sales tax in the U.S. is supposed to be a tax on final consumption. So if you have sales tax and intermediate inputs on some of the inputs business buys, you have the problem potentially of tax pyramiding. where essentially you can lower your overall tax bill by buying your supplier. And you don't really want to encourage vertical integration. So, is it a tax break to exempt business purchases of inputs? In the sense that it's a deviation from what a supposedly neutral tax system would do? I would say no, it really isn't. Maybe it's a violation of that if you only do it for certain industries or certain, I mean, you can get in arguments about that. But so you do have the problem, you have to define what is this neutral tax system or default tax system you're comparing it with. And that's part of the reason why it's hard sometimes for the state reports to be comparable across states.
And it sounds like that's part of the issue of transparency of what these are actually doing, because it varies not just by state, but by type of tax. So let me then turn to another, and this is for everyone, and that is, we have as a title for today, burden or benefit. But Matt, in your comments, you emphasized it's also a shifter. So in the shifting from one part of the state to another, does this make the tax break more clearly a benefit? And I want to start with John and say, you talked about rural areas. Let's talk about Salt Lake City. Does Salt Lake City get tax breaks and drawing companies there? Because you say Utah, all you have to do is put a sign up. And why have these?
Yeah, well, so we sort of divide our state into two areas. There's the Wasatch Front, so that's Salt Lake City and Provo and Ogden-Weber, and Park City's on the other side of the mountains there. And that's the urban or urbanized area. And then there's the rest of the state, which is very, very rural. And indeed, there are a lot of tax incentives in Salt Lake City and on the Wasatch Front. I mentioned that the film incentive is sort of the opposite, where it's shifting benefit from the rest of the state to rural areas. But the stadium deals are certainly an incentive for Salt Lake City. We have something called an inland port, which is a land use authority, and the concept is with this inland port that an importer exporter can operate out of Salt Lake City, and they can ship things overseas through the port of Los Angeles or through Oakland, and they can unpack and pay their tariffs and distribute from Salt Lake City, and so that's a benefit to Salt Lake City. There's another good example that is from Park City to another part of the states. We have a tax incentive for a 5-star resort in Park City, believe it or not. And do you really need an incentive for a 5-star resort? You would think not, except that when you examine what was the purpose of this, it happens to be a military hotel. And so you have to be a member of the military to use this hotel. Arlene was mentioning how you can't afford to go to games anymore. You certainly can't afford to ski in Park City if you're a member of the military, at least on your military salary, unless you go to this place. And the reason that the bosses built this place is because the single largest employer in northern Utah is Hill Air Force Base. And if we lost Hill Air Force Base, the economy would be decimated. And so this is a tax shift from Summit County and Wasatch County, which probably definitely the wealthiest county in Utah, maybe one of the most wealthiest counties in the U.S. It's a shift from that area to Weber and Davis counties in northern Utah, and the concept is if members of the military come here and recreate, the BRAC's not going to close Hill Air Force Base. They're going to become familiar.
This is a customized tax break, which you presumably and your group of economists say net's net.
It doesn't net.
It doesn't net. But then you make a statement that it's understandable for this purpose. Well, let me turn to you, Arlene, and say, are there tax benefits, whatever you call it, tax breaks, tax expenditures that you like?
Yeah, I think, Good Jobs First is not, we are supportive of incentive packages done well. Some of the things that we like these incentive packages to have are requirements for good wages. So some of these go to create minimum wage jobs like Amazon with its warehouses essentially. But if you put in agreements for good wages for workers, benefits that they're full-time, not contract positions, that the hiring is done locally, that there are clawbacks so that if a company fails to perform and do what it said it was going to do, you can get the money back, or even better, make them performance-based. So until they hit their targets, that's when they get the money, which is how the Amazon headquarters, the second headquarters there in Virginia, was structured. So Amazon hasn't been producing nearly the amount of jobs that it said it was, but it's also not getting the money because it was performance-based. So, things like community benefits agreements. So perhaps there's an affordable housing element if it makes sense, or some kind of community give back, a significant one that makes a difference for the community. Not those are the types of things we like to see as part of these agreements, so that the community is getting something in return for the money they're giving these companies.
So, Tim, from your perspective, what makes sense in optimizing tax breaks in terms of perhaps distressed communities versus non-distressed?
Well, I would do several things. I would target distressed communities, and I would limit these tax breaks in non-distressed communities, except in special cases where even within booming communities, there may be distressed neighborhoods, and maybe if you can help people there access the jobs, you can make some exceptions. And the other thing, I would make sure that before you massively fund tax breaks, that you fund some of the infrastructure and job training that the evidence suggests are more cost effective in creating jobs than some of these tax breaks. And so states need to fund more programs where community colleges will train workers for companies so that they can make sure they have the labor they need. Make sure they have the real estate they need. Can they find a site? I mean, I still go back when I first started getting involved in this back in the 1980s. I interviewed a company in Tennessee that had gotten hefty incentives to locate in a particular city. And I asked them what role the incentives played. And they said, well, frankly, none at all. There happened to be an empty factory. We knew we could get into production quickly. It was already zoned for industry. We wouldn't have to go into fights over the zoning and over whether it be permitted or not. We had the highway infrastructure in place. We could ship our goods in and out of the factory, inputs and outputs, so the workers could get there. We knew we could get into production much quicker at this site than at alternative sites in other states. The tax break was nice. We certainly weren't going to turn it down, but it really played no role. And I really think one thing we need to talk about economic development more broadly. It's not just about tax breaks. Some of the most effective economic development programs are dealing with the essential factors of production, which include labor and land.
So let me turn that back to John. And then just as a follow-up, Bill, I'll be right with you, but I just want to push to John. Do you agree that tax breaks are not important in bringing development and specific deals?
I don't. I think they are. I mean, sometimes they're not. Sometimes they are not. The but for is no. Like is yes. Sorry. The but for is whatever the right form is. I would have done this even without the tax incentive. So sometimes that's the case, but it is not always the case. And I think there are some tax incentives that are instrumental. There is a light rail manufacturer in Salt Lake City that moved to Utah from Europe. Because of tax incentives, and all those other things played into it, like the fact that we are the crossroads of the West, and they could deliver their product on rail from their production facility in Salt Lake City to anywhere in the U.S. But they wouldn't have come here; they would have gone somewhere else, like Denver, had we not had the incentives.
And I wouldn't argue with that. I think there are cases where they do trigger decisions. The question is, though, what's the batting average and how does it compare with the cost? So, I've argued in past work, which you can find all over the Upton Institute website, that if you look at the research literature and how sensitive firms are to cost changes due to taxes, which include tax incentives, that the net cost per job created of a lot of incentive programs is about a present value of about $200,000 per job created. Now, that's a lot of money. However, if it's in Flint, Michigan, or rural Tennessee or rural Kentucky, the benefits of job creation are very big. I mean, there are huge effects on the labor market. It can dramatically change people's prospects for getting jobs. On the other hand, if an area is already booming, it's not as clear that $200,000 per job is worth it, given that there may be other things you can do that might be more effective. And so I think states need to think through, be more realistic. Not every tax, your batting average is not 1,000. Even Willie Mays, he didn't bat 1,000. Okay. So we got to allow for that. And that's true of incentives as well.
Susan,
No,
let me just interrupt for a second. In the last about 4 minutes we have, wanted to make sure we get to a very important question that I know is near and dear to Susan as a real estate economist, but it's a very big number. In a lot of locations, affordable housing doesn't get built without tax abatements. There are tax increment financing deals. We mentioned briefly corporate tax, property tax deals to get somebody to locate a factory. So what's the how effective, how good are property tax incentives sort of on the big scale?
Well, I mean, you're bringing up a lot of other things other than job creation, and I don't know what you're asking how effective are they in. I'm sure in some cases they do induce this. I mean, there are a lot of cities, older cities like Detroit, where property taxes are extremely high, right? Because the city has a serious fiscal problem. And so there's some issue where a lot of housing, not just affordable housing, but any housing is difficult for the projects to pencil in without some kind of break. Now, they've recently tried to rationalize this. The mayor's been pushing for kind of moving to a system where you would tax land more heavily than structures, the old single tax idea. It's not clear he's gonna get allowed to do it by the legislature, but the basic idea that in some cases you might need to, I don't think it's crazy. Again, you look at the benefits and costs, look at, what percentage of these projects would not have occurred but for the incentive, and what are the benefits in terms of providing more affordable housing. I focus in business tax things on job creation, but obviously affordable housing, that's not the purpose of affordable housing. The purpose of affordable housing is to get more people into housing they can live in.
But it's an extremely important area.
Oh yeah.
And in the but for argument, unless the tax in New York City, for example, unless the tax system, the entire property tax system changes, as soon as the abatements go away, the new construction stops. So there's a codependency. Susan, this is I want to put you on the spot. This is your bread and butter.
Yeah, two things. Absolutely, incentivizing more housing. And just as you said, Tim, the shift towards the land side and affordable housing is going to be necessary, not just from local states more. It's also not just a local state, it's a national issue, of course, way beyond today, but we'll get back to it another time. Perhaps we can have a lightning round of good or bad, benefit or burden, and what's the one way forward that you'd like to see? And we are going to start with you, Matt.
Tax expenditures, good or bad? Sure,
and
good.
One way forward.
No. I mean, I think that we have to address the burgeoning cost of governance, right? Governance is going to increase in expense a fair bit. And so good. I think it's good.
Good. And way forward. Maybe we'll get a way forward. Arlene, good or bad, way forward?
Well, if they're done right, they can be good, and too often they're not. And I think one question is the opportunity cost, which we all talked about. What do you give up when you give away?
The transparency, what do we give up? John?
Done right, good. And know your full cost of ownership going forward. Make sure you're making informed decisions, rational choices. Sometimes it doesn't pencil, but there could be other reasons why it does, why it makes sense.
Tim, do you want a word here and then back to Bill?
I agree they're both good and bad. The number one things we need a budget for these things rather than an unlimited blank check for business tax incentives. And in addition to having a budget, I think we need to have states consider how to target these on the projects that have the highest labor market benefits for the state.
Before Bill, thank you all, and particularly thank you, Matt, for a great report. Audience, read the report. Bill, please take us away.
All right. Well, And that is it for this edition of Special Briefing. Graham, would you put up the contact slide? I'll give you a second to do that. So you'll see a contact slide on your screen. If you want to get in touch with any of the panelists today or Susan or me, contact information is there, and you can also find it on our website and on our podcast. And thank you so much, just like Susan said, to our terrific panelists. Thanks also to Susan Wachter, our co-host, and to the Volcker Alliance, members of the Penn IUR Board of Advisors, and the Century Foundation, and of course to our production team, Graham Dowd, Noah Ritzenberg, Abby Lingaretti, Dallas Foster, Arden Jordan, and Megan Schmigdal. And special thanks to you, our audience, for joining Special Briefing today.
And Bill, September 20th.
Right,
September
we're taking a summer break, like many of you are, and we'll be back on Thursday, September 19th, with a look at the economy and public finance in the rather consequential months following. So watch our websites and your email for details, and remember to catch up on this and all of our other special briefings on our podcast. And so for now, I'm Bill Glaskell. Have a great summer, and on behalf of Susan, we'll see you in September.